Looking for value in an expensive stock market? Not sure where to turn with so many high-flying stocks in danger of collapsing on extreme stock valuations? Want to know about a stock that offers market-beating value and market-beating passive dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is producing and providing therapies that treat a variety of life-threatening diseases. Quality drug companies may as well own printing presses with the way they print money. And that's great news for investors like us that like to get paid while we sleep. As long as you don't pay too much, an investment in a top-notch pharmaceutical company almost can't lose over the long term. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Gilead Sciences Inc., which appear to be trading at a significant discount today. Gilead Sciences Inc., stock ticker GILD, is a biopharmaceutical company that develops and markets therapies to treat a variety of life-threatening diseases. Founded in 1987, Gilead is now a $75 billion by market cap global drug company that employs more than 11,000 people. The company's three primary disease areas are viral diseases, inflammatory diseases, and oncology. Their HIV franchise accounted for approximately 74% of fiscal year 2019 sales. Biktarvy, which treats HIV, is their most important drug, making up about 21% of total fiscal year 2019 sales. The investment thesis for any global drug company is quite simple. In a world that's growing older and larger, demand for quality pharmaceutical treatments is almost certain to rise. Along with that, the world is growing wealthier. That means rising access to these treatments. These demographic trends work to Gilead's favor. In turn, that bodes well for growing profit and dividend. Gilead has increased its dividend for 6 consecutive years. The company's a bit new to the dividend growth game, but they've been remarkably consistent. Their 3-year dividend growth rate is 11.1%. I think it's very much worth noting that Gilead increased its dividend by 8% right on schedule back in March 2020. That was right when the pandemic was taking hold in the United States. Gilead never skipped a beat. This growth comes on top of a market-smashing yield of 4.5%. That's 160 basis points higher than the stock's own 5-year average yield. And the dividend looks easily covered with a payout ratio of 43.9% of adjusted trailing 12 months earnings per share. This is a safe, market-smashing dividend that comes with double-digit dividend growth. Definitely a lot to like about the dividend. Looking at business growth, Gilead grew its revenue from $7.949 billion in fiscal year 2010 to $22.449 billion in fiscal year 2019. That's a compound annual growth rate of 12.23%. Really impressive stuff here. I usually look for mid-single-digit top-line growth rate from a mature business like this. Gilead did much better than that. Earnings per share advanced from $1.66 to $4.22 over this period, which is a compound annual growth rate of 10.92%. Some margin compression has occurred here. Buybacks offset some of that. The outstanding share count is down by about 27% over the last 10 years. Looking forward, CFRA is anticipating that Gilead will compound its earnings per share at an annual rate of 6% over the next 3 years. The company's HIV franchise, backed by Biktarvy, is the linchpin of the investment thesis. Notably, as of the end of 2019, the company's strong pipeline had 104 active clinical studies. 27 of these were phase 3 clinical trials. In addition, the recent $21 billion acquisition of Immunomedics could pay off handsomely, with the latter's key cancer drug, Trodelvy, receiving FDA approval in April 2020. This drug is expected to have $3.5 billion in sales by 2026. However, the forecast for slowing growth is rationalized by incoming generic HIV competition and the continued shrinking of the HCV market. Regarding the latter, Gilead has in some ways become a victim of its own success. After developing a cure for hepatitis C, they basically eliminated one of their key markets. While certainly great for humanity, the stock's valuation started collapsing 5 years ago as the realization of slowing sales from a big market came to pass. The market priced out those big revenue numbers indefinitely, creating unreasonable expectation and a valuation that was too high. Sales started to stabilize around fiscal year 2018, but the stock's valuation has not stabilized in the same manner. The valuation continued to fall. And that's where the opportunity lies. This valuation is about as low as I've ever seen it on this business. Just as expectations and the valuation were too high back in 2015, it seems the opposite has occurred now. It's not my favorite pharmaceutical company in the whole world, but low expectations have punished this stock beyond what's reasonable. Even with an EPS growth rate near 6%, that allows for a like dividend growth rate. And with a 4.5% yield, you can get to a double-digit total return pretty easily. Gilead simply doesn't have to do much to make it worthy of investment dollars. Moving over to the balance sheet, they have a rock-solid financial position. The long-term debt-to-equity ratio is 0.98, while the interest coverage ratio is over 6. These numbers are just okay on their own. However, Gilead ended last fiscal year with over $24 billion in total cash on the balance sheet. That's actually greater than long-term debt during the same period. The recent Immunomedics acquisition impacts the balance sheet by way of a cash reduction and debt increase, but Gilead is exchanging balance sheet strength for cash flow. Profitability is quite robust, although the margin compression is something that I'd like to see corrected. Over the last 5 years, the firm has averaged annual net margin of 33.26% and annual return on equity of 50.59%. Gilead became a victim of its own success over the last few years, but I think the punishment has been overdone at this point, creating an opportunity to get into a highly profitable drug company with a rock-bottom valuation. And with durable competitive advantages like scale, patents, inelastic demand for products, technological know-how, R&D, and entrenched relationships, the business is in a great competitive position. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I view all three of these risks as being elevated in the pharmaceutical industry. The slowing HCV market and incoming generics for HIV threaten Gilead's sales base. There's integration risk with Immunomedics, and there's the risk that the pipeline doesn't produce enough results to overcome slowing sales from older drugs. Overall, I view Gilead as a quality business that's been almost left for dead at this point. With the stock down almost 30% from its 52-week high, it looks attractively valued. The stock is trading hands for a price-to-earnings ratio of 9.8 based on trailing 12 months earnings per share on an adjusted basis. That's significantly lower than where the broader market is at. It's also materially lower than the stock's own 5-year average price-to-earnings ratio of 16.6. Sales have also been discounted. Price-to-sales ratio of 3.3 is well off of its 5-year average of 4.3. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate due to the high yield and a long-term dividend growth rate of 5%. I'm setting the bar very, very low here. That dividend growth rate is less than half of what Gilead has averaged over the last 3 years. It's much lower than the 10-year earnings per share growth rate, and it's even lower than CFRA's near-term earnings per share growth projection. With a modest payout ratio, they could easily eclipse this. But I'd rather err on the side of caution with so many moving parts, especially with such a large and unproven acquisition just now playing out. The dividend discount model analysis gives me a fair value of $71.14. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stock. Morningstar rates Gilead as a 4-star stock with a fair value estimate of $75. CFRA rates Gilead as a 3-star hold with a 12-month target price of $69. I came out on the low end, but I think we've all put up conservative assumptions. Averaging the three numbers out gives us a final valuation of $71.71, which would indicate the stock is possibly 18% undervalued. Here's the bottom line, guys. Gilead Sciences Inc. is a global drug company that earns billions of dollars and just took on an exciting new acquisition. Low expectations have created a rock bottom valuation. With a 4.5% yield, double-digit dividend growth, a low payout ratio, and the potential that shares are 18% undervalued, this is a unique opportunity that dividend growth investors should take a close look at. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the FIRE Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.